Okay, hello and welcome everybody. It's the end of the quarter again, so I'm back. I'm Vern Cushenberry, Chief Investment Officer, and I want to give you a little market update, and I want to give you a little wisdom, hopefully, so that we can see through some of the dark clouds or maybe gray clouds that we've been getting a lot of questions about, and set your portfolio up for long-term success. If you've been with us a while, then you know that these quarterly updates have a familiar formula. I talk a little bit about the markets, and then I dole out some long-term common sense wisdom that's designed to help reset our focus and get our clients to goal. So let's jump right into it. I know that some of our listeners always like it when I give them the bottom line up front because these updates can run a little long. So the bottom line up front is that the markets were down about 5% in the quarter. The bond markets were down about 5% in the quarter. And some of our retirees, near-term retirees especially, rely on more of those income portfolios. So that can be a little bit alarming. I'm going to take a deep dive into that this quarter, talk a little bit about fixed income, inflation, so on and so forth. And then I'm going to point out how trying to handicap what the market does next has historically been a loser's game, and highlight the advantages of a longer term buy and hold approach and how that's weathered many environments over the last 100 years and is likely to do well for our investors in the future. I'm going to touch on oil. I'm going to touch on inflation. I'm going to touch on the war in Ukraine, talk about some of those charts, and then segue to, let's see, what else is a little bit about the dollar, and that'll about wrap it up. So let's jump right in. I'm trying to do a better job of looking at the camera this quarter because I got some feedback from my mom. Mom said, hey, do a better job of looking at the camera. So, hey, Mom, love you. Thanks for the advice. Thanks for being my biggest fan. Here's the quarterly returns for, this is data ended March 31st, 2022. You can see that domestic stocks were down about 5% there. And I mentioned the global bond market, domestic bond market. This is really the big news in the quarter. And what's driving this is inflation. Inflation in the second quarter, here most recently in April, hit 8.5%. And I think we all know what the drivers of that. We had deflation. We had deflationary stresses on the system during COVID that nearly shut down our economy. We had huge stimulus. We had supply chain constriction. So we had a supply crunch. We weren't getting as much supply into the market for nearly all goods and services. And then we had our government stimulate in the wake of that. So we had nearly $4 trillion in currency that was pushed out into our economy in a variety of different ways, variety of different mechanisms. More currency creates demand. So we had a supply crunch and increased demand. That creates inflation, and we're working through that. We've seen this before. There's a lot of forces that bear on those inflation numbers, but the Federal Reserve describes those as transitory. It's just a question of how transitory. How quickly do we work through those? Does it take months? Does it take quarters? Does it take years? Some of those forces will relieve themselves inside of the next few months or a few quarters. Others, it's going to take longer. But we have a playbook for this, and we absolutely will get through it. So let me jump to, excuse me while I check my notes here. I always have way too many slides than can be shared in a quick presentation. So I highlight a few, and I try to pick different slides every quarter so I can give you all a good perspective on the markets if you join me every quarter. So I want to go down here to slide number 15. And let's see here. Slide number 16, excuse me. And I meet quarterly with I meet weekly with our investment management team, but quarterly we all get together and we share notes about what we're hearing from our clients, what some of the concerns are, questions are, hot topics, and I try to address some of those. And when we got together this quarter, I was specifically asked for this chart, meaning I think it would be a good time to review this because in the quarter, we were very briefly down 13%. We hit 13% down and then bounced off that low very quickly. Well, that identifies in technical speak what the market thinks of as a quote unquote correction. If we had slid to a 20% decline, that would have indicated a quote unquote bear market territory. These thresholds are arbitrary, but they're meaningful when we look back at history, and that's what this chart does. And we can see here that going all the way back to 1980, what you're looking at in gray is how the market finished up year over year. So from January 1 to December 31st, 1980, the market was up 26%. You can see that last year it was up 27%, not too bad. Well, these red numbers at the bottom are the maximum drawdown during that 12-month period of time. So you can see that in almost every year, even in 1980, the market was down 17%. And the general drawdown, if you look back over this period of time, is an average of 14%. So that's almost exactly what we saw in the first quarter. You can see here that the market was down 13%. That came as a little bit of a shock. If it came as a little bit of a shock to you, consider yourself normal. That's the normal response when you see your portfolio down 13% or a fraction of that. It's my job to contextualize that. And when we look back over history, there's almost always some event mid-year, whether that be geopolitical or economic or some other exogenous shock to the system that feels like a start, gets your blood pressure going. I'm not immune to this. I sit down, I watch the nightly news, I can feel my heart start to beat a little faster and my blood pressure go up. That's the normal fight or flight response. And then with the benefit of long-term perspective and wisdom, we fight through that, and our portfolios benefit from that long-term buy and hold approach. So I just wanted to share that this quarter. I'll probably, that's a chart I try to share at least once a year. And I have another one that is an oldie but a goodie that I want to go back to this quarter as well. So having said that and put some perspective on the markets, let me go to slide number, I think it was 26. Let's talk a little bit about inflation. Again, I mentioned largely driven by the supply crunch and increased demand from the added stimulus. We had supply chain issues. We had what economists are now referring to the Great Vacation. So many people exited the workforce. Many of those workers are now starting to re-enter the workforce. So some of those COVID factors are starting to rectify themselves. Inflation spiked significantly, but we do have at least the supply chain, some of the wage concerns, those are starting to rectify. The war in Ukraine is a new one, and that has a big and outsized effect on energy prices. You can see here that energy was up 25% just in the second quarter. So that's one that we don't have a clear handle on yet. We're working through that. I'm going to show you a slide here on energy in a moment that will put that one in perspective. That one's one of the forces that's likely to be longer term in nature. And then lastly, we have the stimulus, which is also likely to be longer term in nature when you put that much increased currency, when you stimulate through quantitative easing measures. It takes a few quarters, if not a few years, for that to work its way through the system. So having said all of that, we're at or near peak inflation. We expect that to start declining over the second quarter, third quarter, fourth quarter of this year, but we also expect it to remain elevated for a period of time. So that's going to give us an opportunity to take advantage of periodic rebalancing, and for investors that are closer to goal or have a shorter term time horizon, that gives us an opportunity to be a little bit more tactical and make some more pronounced adjustments to your portfolio. I've mentioned this before, but I thought it was worth mentioning again. When you think about inflation over the longer term, there are some secular forces that are helping to tamp that down. Primarily demographics. We have the largest, or now the second largest generation in the baby boomers. I think the millennials are actually a little bit larger, but the baby boomers are entering retirement. When you enter retirement, typically you decrease spending a little bit. That takes a lot of demand out of the economy. that demand reduction helps keep inflation in check. We also have technology that's a mitigating force and has been for a long time. As technology enters into every industry, it has a tendency to increase productivity, which puts more goods into the marketplace, more goods and services into the marketplace, and greater supply is a mitigating factor to inflation. And then lastly, we have globalization. We still have nearly 3 billion people on the planet that are at or near that poverty line, trying to claw themselves out of that circumstance, which is a mitigating force on global inflation. Globalization is, you could argue that it has been paused by this war in Ukraine, and that argument has some merit. So we're paying very close attention to that, as you would expect. Okay, let me move on to slide number 28 here, and I want to talk a little bit about the dollar. You can see that this quarter, the dollar has rallied. Anytime we have geopolitical unrest on a global basis, it's not uncommon for the dollar to rally, because the United States is one of the biggest trading partners of the world and largely seen as one of the most trustworthy counterparties in the world, which is why we print the world's reserve currency. And when we see any unrest on a global basis, the dollar typically rallies. Now, that also is a mitigating force when it comes to inflation, because the stronger the dollar is, the cheaper it is for us to buy and import foreign goods. So the war in Ukraine is likely a factor that will support and continue that trend over the longer term. We also see the Bank of England, the Bank of Japan, and the Chinese central bank stimulating their economies. And as they stimulate their economies with quantitative easing measures, the dollar is likely to rally in the face of that as we start to take some of those stimulus measures out of our economy. Makes the dollar look relatively more attractive. Our interest rates are rising. A higher interest rate relative to some of your trading partners makes our currency look more attractive, and that has tailwind effects for the dollar. So we're mindful of that. Okay, next slide. Here's oil. I mentioned I wanted to talk a little bit about oil. Look at Russia here. You can see that Russia produces about 11% of the world's total production. So that's very significant. The price of oil has gone from a low of $11.57 during the depths of COVID, now all the way up to over $100 per barrel as of the end of the quarter. And that's a very challenging thing to handicap what happens next in the face of all this geopolitical turmoil. You can see that the United States is forecast to significantly increase its production. We went from 19.5, I think this is millions of barrels per day, to 18.6 in 2020, and then we've started to increase production again. You can see that over the course of the next year, we will go from 20 to 21, and this chart at the bottom of the page shows our active rig counts. We're drilling again, which is a good thing for the price of oil, and we're watching this data quarterly and trying to estimate how this is going to impact the overall price of inflation and ultimately our investors' cost of living and the portfolios that we designed to meet that cost of living in the longer term. Okay, let me segue a minute here, and I'm going to switch. Okay, let's see if that I found on the internet in the last 3 months. I monitor probably 3 dozen different blogs and news feeds and market sources of market commentary as you would expect. And one of my favorites is written by Barry Ritholtz. This is his blog here, and I flagged it this quarter. And let me just blow it up for you here, because this actually comes from a piece that was written by JP Morgan, I believe, and it talks about the accuracy of pundits' forecasts. And I can shortcut it for you here. When you hear some talking head on CNBC parroting some economic data and then forecasting that the market is about to crash. Well, it would be wise to consider that if you take a measured look at all those forecasts over the past 1, 3, 5, 10, 15, and 20 years, almost none of them come to fruition. And the ones that do are like a broken clock being right twice a day. Because if you claim that the market is about to crash over a period of 15 years, you are going to be right sooner or later. And that's what we see when we look at some of the forecasts of the most widely followed and generally considered to be some of the most astute portfolio managers on Wall Street. And this just kind of shows the forecasts that some of them have made over the last 6 years, talking about how much risk is in the market. And then the market subsequently rallies. Well, if you look at the last 5 or 6 years, over 100%. So you risk a lot as an investor if you choose to move your money to the sidelines, because it's not uncommon for the markets to behave with knee-jerk responses on the upside as soon as there's any clarity with regard to some of the risk that's embedded in the market. You can see here, here's just a simple spreadsheet laying out the date and this article calls it the Armageddonist, and then the quote of what they were forecasting and the inaccuracy of that. You know, here's Peter Schiff. What the Fed is doing is extremely bearish for the US economy. It ensures that this recession, depression that we're entering is going to be extremely brutal. Well, that was March 25th, 2020, and the markets were up probably 60% since that forecast. So just be careful when you're listening to some of these pundits, these talking heads. Generally, they have a book of business, they manage money, and fear sells. Wisdom, on the contrary, is a very difficult thing to sell, because it's like watching paint dry. You know, how many times can you say the markets benefit, buy and hold investors? The temptation is to try to do a little bit better, but that temptation, again, hasn't historically worked out well for investors. So I want to leave you today with 2 final charts. We go down here to slide number 60. I was asked by one of our CFPs, our financial planners, to share some of that wisdom with this chart that shows that long-term, say 50% equities, 50% bonds, nothing too exciting, nothing too glamorous, which is indicated here by this, what we call this asset allocation portfolio. It's right in the middle. It's never going to be the highest performing asset class like emerging markets was in 2007. It's never going to be the lowest performing asset class like REITs were in 2007. It just kind of bounces around. You're always going to get something in the middle of the spectrum there. And what that does for you as an investor is that it allows you to benefit from that compound interest over time. And that's exhibited here in this chart, which is slide number 52, that shows the power of that approach. And that's in gray here, a 50% stock, 50% bond portfolio. Look at what happens to that portfolio over time. If we look at any 1-year period, and this is a period dating back to 1950. So in any 1-year period from 1950 to 2021, you see stocks in green fluctuate from down 39% to up 47%. You see bonds in blue, a little safer, fluctuate from down 8% to up 43%. Now, a 50-50 portfolio, which we just looked at on that prior slide, has fluctuated from down 15 to up 33. And that's what we've seen just in the first quarter of 2022. We saw the markets, that's equities, but bonds have been down about as much, down, at its trough, 15%. It's important to maintain focus on the time horizon that you have as an investor. If typically these funds are invested for retirement or for the long term. That gives us a 5-year, 10-year, sometimes 20 to 30-year time horizon. Well, as we pan out, in any 5-year period over that time span dating back to 1950, a 50-50 portfolio has never lost money. It has spanned from a 1% return on the low end to a 21% return on the high end. So if you have the message here is clear. If you have a 5-year time horizon, take a deep breath, consider this information. It should give you a little bit of perspective. It's never been the case since 1950 that portfolio has lost money over a 5-year time span. Pan out to 10-year, pan out to 20-year, the message just gets even more positive. So I guess the moral of the story is this quarter, we've experienced a little bit of volatility. Let's just refocus on some of those aspects of investing that are closer to truisms, and we can only focus on those with the right data on hand. I'm here every day to answer questions. Please reach out to me, reach out to your financial planner specifically to get an update on how some of these concerns are affecting your portfolio. And again, if anything about your time horizon has changed, let's revisit the risk that's inside of your portfolio and make sure it's still right to power those long-term goals. So I'll be back with another market update next quarter. Until then, thanks again.